All right, welcome back to another episode of Asset Coach and Tax Strategist, and here we go. Let's start our series. So we did a little bit of update last week and kind of give you an overview of what the next few episodes are going to look like and why we're doing what we're doing. So without further ado, let me share my screen, and hopefully you were able to buy my book, Economic Termites. We gave you the link. If you haven't done so yet, feel free to do it now. You don't need it, but it'd be a nice tag along to be able to highlight. I'm going to highlight certain areas. You may want to write notes in the margin or in the space that's provided. Use it as your textbook. Remember back in the day when we went to school and we wrote in the books and stuff? Well, more college than high school. We would get in trouble if we did in high school, wouldn't we? Now, this generation doesn't even know what books are, right? They don't have textbooks, right? I think most of the time they're all online. They get access to it. But anyways, it's a different conversation. So let's dive into the beginning and foundation, okay? So again, like I was talking about before, is that we need to understand some basics. So let me increase the size here so we can see it. Whoa, that's a bit in our face. There we go. All right, so cash flow, right? We were talking about in the last episode the idioms and cash is king, and how I said that's not right. It's the flow of cash. So cash flow is the net amount of cash and cash equivalents being transferred into and out of a business. Okay. At the most fundamental level, a company's ability to create value, that's important for shareholders, which is yourself if you are the only owner. And if you are having a family or you have a family, they may not own the business 100% like you do, but they are your family, your heirs. Therefore, they are technically shareholders, just not in the company or the business documents. So create value for shareholders is determined by its ability to generate positive cash flow, or more specifically, maximize long-term free cash flow. Now, this comes from Investopedia. Now, here's what we're talking about, looking at. So positive cash flow is very important. But the reason why people come to us in our practice is because they have a tax problem. Well, they've done a good job of generating positive cash flow, and they don't know what to do with it. And they may not like the advice that they're getting from their current tax people. So they come to us and say, hey, I heard that you guys may be able to help. What do you do? And we tell them what we do. And they're like, whoa, that's amazing. That's what we want to do. And so therefore, what do we want to do? We want to maximize long-term free cash flow. What do we want to put in front of the word free? Tax. We want to maximize long-term tax-free cash flow. That's what we want to do and focus on, okay? That's a very, very important aspect of building wealth, and not just your wealth here, but the generational wealth and how to do that, okay? Even profitable companies can fail if operating activities do not generate enough cash to stay liquid, okay? We'll talk about liquidity. Liquidity is different than cash, right? Liquidity is a type of cash. It's a type of usage of cash, right? It's a short-term storage facility. It's a short-term storage facility to be able to have access if there's an event or a situation or an opportunity that arises. This can happen if profits are tied up in accounts receivable. This is bad. We actually have another business that we have, and we've had struggles, and we've had to change our processes of accounts receivables, because even though people owe you the money doesn't mean they paid you. Money's only good when it's in your account. Just because it says I'm supposed to receive this doesn't mean you actually will. It's the same thing as, oh, I'm going to sell my business when I retire. Great. What's someone going to buy your business for? It's not what you think of value it is. It doesn't think what you want to sell it for. It's what someone's willing to buy it for. So that's important. Inventory as well. Just-in-time inventory has been a very, very active thing as computer systems and softwares have improved, automating, manufacturing. Just-in-time inventory has shrunken down. The inventory time has made better use of the flow of cash within inventory. But also the thing of companies spends too much capital expenditures. Okay. Now, sometimes this happens to actually be planned. planning that sometimes professional advisors will do. There's a process in utilizing free cash flow. There's a process in this, and sometimes advisors, well-meaning advisors, as well as you as a client, want to have a certain accomplishment, but there is certain types of decisions that are cart before the horse. Let me give you an example, and we'll bring this example and other examples up multiple times in our videos. But we have a client who we had met in December. Why did we meet him? Because he saw that we did tax planning. He's tired of paying taxes. Now, he's tired of paying unfair taxes. We all should be paying our fair share. Okay, let me make sure that's clear. We all use certain aspects of our society where we should be paying our fair share in taxes. Okay, now what does that fair share definition means? It's different for everybody. And that's what the tax code actually allows you to define your fair share based on your individual situation and your assets. So what happens is this guy wanted to save money in taxes, and he met with us, and it was just really new, and we were able to help him, but it did take some time to understand our language, which is why we have a YouTube channel to kind of explain our language. Our language is not unique. It's English, but it's English in words. Books are just organization of words. It's all English, and we can have shelves and shelves of books. It's all the same letters in the alphabet. It's all the same words, but they're organized in a way that tells a story. Your assets are the same way. That's actually a really good analogy. I'm going to use that more. That you are the first people to hear that analogy from me. We're using that. Date this on the calendar. But anyway, so back to the story. Sorry. So he's talking to another advisor, and hey, yeah, I want to save money in taxes. And this other advisor presents to him a retirement program. Okay. And which is not a bad thing. It's a good asset, but it's in this client situation is in the wrong order. It was cart before the horse. Here's why. Yes, he did put money into it. Yes, he was able to save money on taxes, check and check, right? So that advisor, great job, high five, slap on the sport butt. We're good to go. No. Fast forward to the beginning of the year. We're in January now. We're in February. We get together with the client and start talking about more of what we can do and planning and stuff. And he's like, hey guys, I have this big issue. I need access to capital. Well, we knew that in December because he's in growth mode, right? And a business can be always in growth mode. Look at Amazon. They were a public company, and for 20 years, they were a public company showing a lost in their financials. Why? Because they're a growing company. They're taking all their profits and building business, reinvesting in themselves. Okay. So you don't have to be a growing company and be a few months or a few years old. You could be a very well-established company in wanting to grow. How do you grow? You need access to capital. So in this situation, they put in over $300,000 into this retirement program. Well, what's a retirement program for? It's not to save money on taxes. It's to save for retirement. A byproduct is tax savings. It's an asset. He made a decision to take this $300,000, put it into this asset, and as a byproduct, he got a tax savings. But as a byproduct, that cash flow, that capital is locked up. Don't get access to it. So fast forward to January, February. Hey, I need cash flow because I'm trying to build my business. I need capital. We're like, yeah, that's why we told you not to do that. But it didn't make sense to him at the time until he actually made the action, took the action, and saw the results of that. And he's like, oh, now I understand what you were saying. That's why we do a YouTube. That's why we write books. That's why we give this content, this information, is that you need to understand some of the very, very basics, because your decisions have consequences, good and bad. Okay. So this is very important. So a company might have lots of cash because it's mortgaging its future growth potential by selling off its long-term assets or taking on unsustainable levels of debt. So this is an important aspect as well. We need to also understand liquidity. It is an activity of cash being stored, and it is short-term. So we need to understand, hey, if we're gonna sell off a long-term asset, why? What are we doing? Okay. We're just not mortgaging assets for giggles, right? So I've had some clients where we've done some new clients, and we have done some strategies and freed up some cash. They have taken that cash and then they went and bought a boat or a vacation condo. And they turned that asset, that cash that was stored, that we were able to free up some cash out of one asset, and the goal was to take that cash and put it into another asset and duplicate assets. And now they have these two assets appreciating and growing. But then they bought a liability, a boat or a vacation home. And that now a vacation home could be an asset, but their mind was not an asset. Their mind was like a boat. Blew up the plan. Now they got to work harder. The plan, the time, we're buying back time. Now we gave up time. So we took 2 steps forward, 3 steps back. Okay. So it's important to understand in the planning process what we want to do. Okay. So let's fast forward to what's this mean? Why am I saying this? Well, because if you read Malcolm Gladwell's book, Outliers, he talks about it's a story of success, and he talks about this rule of 10,000 hours, and he used it various examples like Gates and Jobs and Kobe Bryant and various examples in the book to show how if you accelerate your 10,000 hours in training and education, you actually become an expert in something. Well, guess what? I've spent 20 plus years becoming an expert. I can give you the list of hundreds and thousands of books I've read. Are you going to invest 20 years to build up or whatever, to build up your own 10,000 hours? Or do you want to just get a cheat code and follow our guidance? Right. And that's what this content is. So that's what he's talking about. So you have an expertise. You're watching this. You have an expertise. You've built your 10,000 hours in what you do. Right. So if I were to just come into your shop or your business and say, all right, now put on a stethoscope, let's go see patients, what would you do? But because we talk about finance and it's so readily available to everybody, that's what you do. That's what people do, is they just put on their financial expert cap and they just go make decisions without having that training and that expertise. Okay, which is fine. That's why I exist, but it's still a consequence to decisions. All right. So what I want to do is I want to go into Robert Kiyosaki's cash flow quadrant. And so I'm gonna lead up into this. Okay. I'm gonna lead up into this, and what I'm gonna do is depending on how long-winded I am. Oh man, I just love this so much. A minute turns into 20. And it's like, holy cow, where'd the time go? But I just want to pour into you. I just want to give you everything that I've built up between these ears and just pour it out into you. And so it just goes by so quick, and there's so much to say and want to give to you guys. So anyways, so how did my journey start? How did this all begin? Well, I read Rich Dad, Poor Dad. So it was very popular when I had originally read it. And I loved his story of talking about the different mindset of money and thinking about money with his dads. His rich dad had a different type of mindset. His poor dad had a different type of mindset. Both dads were well-meaning and made their decisions based on their training hours and expertise. So they were both right. What was the difference is what Robert Kiyosaki wanted out of that information. That's what made the difference if one was better than the other. Because there's a lot of people who take poor dad's path in being an employee, being a government worker, W-2, whatever the case may be. That's not a bad path if that's the path you've decided you want to go. There are consequences to that. And you are agreeing to those consequences knowingly or unknowingly. The same is true on rich dad's side. Okay, there are consequences. Just because I'm a business owner doesn't mean I don't have headaches. I have different headaches than I did when I was an employee. Not one headache was better than the other. They both were painful, and they both have to be dealt with. Okay. And so that's what we're doing here is we're dealing with this by understanding the education. So after I got done reading his book, what do you do when you read an author's book and you're like, man, that was good? You go and see, do they have a second book? I want to go read the second book. Right. And so that's what I did. Cash Flow Quadrant was his second book. And I went and bought that book. And I read that. I closed up the book when I was done. I leaned over to my wife of 2.5 years and I said, babe, I'm quitting my job. You can imagine her reaction. Oh, and so, anyways, it gave me the mindset and to decide on what I wanted to do. It gave me the knowledge that I decided I wanted to do something with this knowledge. Okay. And so I enjoyed the finance. I wanted to work with people. I enjoyed talking to people. I'm somewhat of a social person when I want to be. And so I wanted to combine, and that's where the financial service industry part came in and play. And it said, like, I could do it here, right? I can combine both of these things I enjoy into overlapping into this particular industry. Now, that was the decision, but Cash Flow Quadrant was life-changing, and it is to this point today. Okay. So I got into the financial service business in 2001. And at the time of this recording, it's 2024. Okay. So 23 years later, and it's been life-changing. Now, I'm not going to lie to you. There's been moments where it's like, this sucks. And then there's been moments like, what did I do? And then there's been moments where like, whoa, this is awesome. This is oh, thank goodness I made that decision back then. Thank God I was immature, young 20 something year old kid who didn't know all the things I know now. And I made that decision so confidently and successfully. Heck yeah. And that foundation of habits has grown. And I'm not gonna lie, I have put some bad habits in between some of those good habits, and I go, oh, bad habit, got to change that, right? And some I've been able to, and some I'm still struggling at, right? That's life. That's the journey of being human, doing, right? But Cash Flow Quadrant, we're going to dive into in the next session. Okay. And it's just so excited to talk about this. And I wanted to do it here, but then we're kind of at that timeline where it's like, yeah, I could do it, but it's going to take this video to be much longer than I want it to be, probably much longer than you want it to be. You may need a little break for me. And so it's best for me to just go ahead and end the video here. Let's go to the next session. Check out next week's. We're going to be talking about the Cash Flow Quadrant. Thanks for joining us. Subscribe, thumbs up, comment. You know what to do. Thanks so much. Have a blessed day. God bless.